It was like out of a science fiction movie. It's like they never existed. I never got a letter. I never got anybody calling me. I follow those principles a lot in what I do. There are very many companies where the CEO doesn't care. He's making a lot of money. And today, it's very dangerous because a lot of these mediocre companies are borrowing money. And they're borrowing money very cheaply. And that's what theoretically makes the earnings that I think are very questionable.
Have you ever wondered what really separates billionaire investors like Carl Icahn from the rest of us? While the financial media loves to highlight his famous corporate raids and activist campaigns, these headline-grabbing moves are just the tip of the iceberg. Behind these visible strategies lies a sophisticated investment approach that has actually built more of his $24 billion fortune than the activist plays everyone knows about. Today, I'm going to take you below the waterline to explore the hidden parts of Icahn's investment empire, the strategies that rarely make headlines but have been crucial to building his enormous wealth. These principles don't require billions of dollars to implement. They just require a different way of thinking about markets, value, and time. The energy behind Icahn's investment decisions. Imagine walking into a casino where most people frantically jump between slot machines, while in the corner sits a calm card player methodically building his chips over hours. That's how Icahn operates in the market, with focused energy on finding situations where the price of something valuable is temporarily disconnected from its worth. 1. The contrarian value base. Everyone knows Icahn buys troubled companies. What they miss is that underneath those activist moves is a pure value approach with a twist. Icahn targets businesses where the market has overreacted to temporary problems, the company has valuable assets not reflected in the stock price, or most investors have moved on to trendier opportunities. Take his Apple investment in 2013. While media focused on his campaign for buybacks, they missed his timing, buying when Apple had fallen almost 40% from its highs after Steve Jobs' death. He recognized that Apple's ecosystem was vastly undervalued, generating over $2 billion in profit from that insight. This contrarian approach requires tremendous psychological energy, being comfortable going against what everyone else thinks when headlines are screaming doom. 2. The distress step play. While everyone watches Icahn's stock moves, one of his biggest wealth builders has been buying the debt of troubled companies at deep discounts. When businesses get into financial trouble, their bonds often get dumped by institutional investors, pushing prices down to 30 cents or less on the dollar, even when the company has enough assets to eventually pay much more. Icahn buys this discounted debt and uses his position as a major creditor to influence outcomes. Often, he converts debt to equity ownership during restructuring, essentially buying businesses for pennies on the dollar. His investment in Tropicana Entertainment exemplifies this, buying the casino operator's debt during its 2008 bankruptcy, converting it to ownership, then selling the company 10 years later for $1.85 billion. This strategy requires intense analytical energy, understanding complex debt structures, bankruptcy procedures, and asset values, but has been a consistent profit center that receives little public attention. 3. The sector expertise concentration. While financial advisors tell average investors to diversify broadly, Icahn concentrates in sectors where he's developed deep expertise, particularly energy, real estate, and industrial companies. This specialized knowledge gives him a tremendous edge in identifying value others miss. His energy investments span the entire value chain, from drilling and production to pipelines, storage, and refining. When oil prices collapsed in 2014 to 2015 and again during the pandemic, Icahn was buying energy assets while others panic sold. His sector knowledge gave him the confidence to act when prices disconnected from long-term value. This concentration strategy requires tremendous intellectual energy, developing expertise in complex industries most investors find boring or too complicated. But this boring knowledge has been a goldmine for Icahn over decades. 4. The option strategy overlay. One of Icahn's least discussed techniques is his sophisticated use of options. Unlike retail investors who use options for speculation, Icahn employs them strategically within his broader investment framework. When building large positions, he often uses options to establish initial exposure before fully committing capital, effectively locking in purchase prices while continuing research. Similarly, when exiting positions, he may use options to secure minimum selling prices while retaining upside potential. This approach requires strategic energy, understanding complex pricing models and volatility patterns to enhance returns and manage risk across his portfolio. It's not gambling on price movements, but using these instruments as precision tools within a larger strategy. 5. The private market advantage. Beyond public markets, Icahn has built substantial wealth through private transactions that never make headlines. Through his investment vehicles, he acquires entire businesses, real estate holdings, and private equity stakes that provide both steady cash flow and long-term appreciation. His acquisition of auto parts manufacturer Federal Mogul demonstrates this approach. After taking it private completely in 2017, he applied his operational improvement playbook before selling to Tenneco for $5 per billion in 2018. The energy behind successful private market investing combines financial analysis with operational expertise and strategic vision, making it a significant wealth builder that rarely receives attention. The time dimension of Icahn's wealth. Who would you rather be? Investor A, who makes a flashy 50% return in 1 year, but then struggles for a decade, or investor B, who consistently earns 15% year after year, quietly compounding into a fortune? Icahn's career demonstrates the power of being investor B, focusing on sustainable returns that compound over decades instead of chasing whatever's hot right now. 1. The multi-year holding period strategy. While Icahn's activist campaigns suggest constant trading, many of his most profitable investments have been held for years or decades. His position in AutoZone began in the late 1990s and continued for over 15 years, during which the stock rose more than 2,000%, with almost no public commentary or drama, just steady belief in the business model. This patience allows Icahn to capture the full value creation cycle, from initial undervaluation through improvements and market recognition. It requires the discipline to hold through volatility, maintain conviction when positions become boring, and focus on business performance rather than price movements. 2. The strategic timing of cycles. Rather than trying to time daily market movements, Icahn positions his portfolio to capitalize on predictable industry cycles that unfold over years. In energy, for example, he repeatedly builds positions during deep industry downturns when assets are available at distressed prices, then patiently holds through recovery phases. This approach combines macro insight with extraordinary patience, sometimes waiting years for cyclical plays to work out. The time discipline of cycle investing comes from acting countercyclically, buying when others are fearful and selling when optimism returns, often years later. 3. The compounding machine structure. Through Icahn Enterprises, IEP, he has created a vehicle that allows capital to compound with minimal tax drag and maximum reinvestment potential. Successful investments generate returns that are largely reinvested rather than distributed, creating a compounding effect where each successful investment increases the capital base for future opportunities. This approach contrasts sharply with most investors' tendency to extract gains for consumption. Icahn's framework prioritizes exponential long-term growth over immediate rewards, perhaps the single most important factor in his wealth creation over decades. 4. The value of time arbitrage. One of Icahn's most powerful strategies is exploiting the difference between Wall Street's short-term focus and the actual long-term value of businesses. When markets overreact to quarterly results or temporary setbacks, Icahn often takes the opposite position, waiting for perception to align with reality over time. His Netflix investment exemplifies this, buying in 2012 after the stock plummeted due to concerns about the streaming transition, then selling 2 years later at roughly 5.5 times his purchase price for a $1.9 billion profit. This time discipline comes from separating market noise from business fundamentals and maintaining conviction through volatility. The psychological edge, Icahn's mental framework. What truly separates Icahn from other investors is his psychological approach, a mental framework consistent through decades of market cycles that represents perhaps the most valuable aspect of his strategy for others to emulate. Icahn's most distinctive trait is his comfort contradicting prevailing market sentiment. While most investors seek confirmation of their views, Icahn often sees consensus as a signal of potential opportunity in the opposite direction. When the energy sector was deeply out of favor during the 2020 pandemic, Icahn maintained and increased certain energy holdings, recognizing that markets were pricing in permanent demand destruction that was unlikely to materialize. As energy rebounded in subsequent years, these positions generated substantial returns. This requires immense psychological energy, the conviction to stand alone against prevailing wisdom, emotional stability to endure criticism, and patience to await vindication. Unlike investors who become emotionally attached to their theses, Icahn maintains clinical detachment that allows reassessment when conditions change. This objectivity extends to his own decisions, willingly reversing course when new information suggests his initial analysis was incorrect. When Hertz was devastated by pandemic disruption in 2020, Icahn sold his entire stake at a substantial loss rather than hoping for an unlikely recovery, freeing capital for other opportunities. This intellectual honesty requires the discipline to continuously reassess positions without ego and the courage to act decisively when conditions warrant change. While most investors avoid confrontation, Icahn has built his reputation on challenging management teams, boards, and other investors when he believes value is being destroyed. This isn't about personal animosity, but creating accountability, understanding that corporate governance sometimes requires active engagement to align management incentives with shareholder interests. His campaigns at Apple, Dell, and numerous other companies demonstrate this approach. By publicly advocating for specific actions, whether share repurchases, operational changes, or strategic alternatives, Icahn creates catalysts that accelerate value realization, requiring both conviction in his analysis and courage to advocate publicly despite resistance. Applying Icahn's principles to your own portfolio. While most investors can't replicate Icahn's specific positions, the principles underlying his approach can be adapted to portfolios of any size. 1. Develop your high-energy investment framework. Start by defining your own investment philosophy, the core principles guiding your decisions regardless of market conditions. This might include value-oriented criteria, qualitative business assessments, and risk management parameters. Next, build your analytical toolkit. Learn to read financial statements thoroughly, understand industry dynamics, and evaluate competitive advantages. The energy invested in developing these skills will generate returns throughout your investing career. Finally, create a personal research process you follow consistently. High-energy investing isn't about working harder, but working systematically to identify opportunities others miss. 2. Master the time dimension of investing. Extend your investment horizon from quarters to years and decades, creating a portfolio structure that allows for uninterrupted compounding. Develop the patience to hold through volatility when your thesis remains intact, recognizing that significant wealth creation requires giving investments time to develop. Structure your personal finances to support your investment time frame by maintaining adequate liquidity outside your portfolio, so you're never forced to sell long-term holdings to meet short-term needs. 3. Build your layered portfolio structure. Create a base layer of high-quality, undervalued companies generating strong cash flows. Positions you're comfortable holding for years. Around this core, add investments benefiting from specific trends you've identified through research, industry consolidation, technology transitions, or demographic shifts. For your opportunistic allocation, develop a framework for evaluating special situations like spin-offs or restructurings. Consider appropriate hedging strategies based on your specific exposures rather than trying to predict market movements. Maintain flexibility to adjust allocations as market conditions change. 4. Cultivate the psychological traits of successful investors. Train yourself to question consensus views and seek independent analysis. Practice objectivity by regularly challenging your own investment theses. Develop comfort with being temporarily wrong as part of the investment process. Build patience to allow investment theses to develop over appropriate timeframes. Cultivate the conviction to act decisively when exceptional opportunities arise. Begin by recognizing your own psychological biases, then create decision-making processes that counteract them. Structured analysis templates, pre-commitment to specific actions under certain conditions, or regular portfolio reviews with predefined evaluation criteria. 5. Focus on energy, not just returns. The ultimate lesson from Icahn's career is that investment success is fundamentally an energy equation. The energy you bring to your analysis, conviction, and patience directly influences your returns over time. Commit to continuous learning, reading annual reports, studying industry trends, understanding businesses at a deep level. Cultivate psychological energy through proper self-care, recognizing that successful investing requires emotional stability and clear thinking. Maintain perspective on the true purpose of your investing, creating options, security, and opportunity for yourself and those you care about. So, when you strip away the complexity, Carl Icahn's secret portfolio reveals something profound. Investment success isn't about special information or extraordinary intelligence, but approaching markets with a different energy and time perspective than most people will adopt. The strategies generating his most consistent wealth aren't the headline-grabbing activist campaigns, but the patient accumulation of undervalued assets, deep sector understanding, willingness to contradict consensus, and psychological framework allowing clear thinking when others become emotional. These principles can be applied by any investor willing to bring the right energy to portfolio decisions and adopt the right time frame for wealth creation. Markets reward those who think differently, not those following the crowd. The next time you see headlines about Icahn's latest activist move, remember it's just the tip of the iceberg. The real wealth-building machine operates beneath the surface, guided by principles that have stood the test of time across multiple market cycles. The question isn't whether you can replicate Icahn's specific investments, but whether you can adopt the energy, time perspective, and psychological framework that have made his approach so successful for decades. The ultimate secret of Icahn's portfolio isn't what he buys, it's how he thinks. And that's something any dedicated investor can learn to emulate.